Good evening and welcome to Heritage Capital Wealth Talks. We live in a world where crises no longer respect borders. Inflation in Washington hits families in Bucharest. A downgrade in Europe shakes confidence across New York. A banking collapse in one country can freeze liquidity everywhere in hours. Tonight's guest, Dr. Lemand, has not only studied those storms, he has lived them. From managing billions in Paris, London, New York, to advising government on financial stability, to designing family wealth structures that survive global contagion, few have his perspective. But here is the truth. While risks are global, their impact is always local. And in Romania, the impact is magnified. Banks overloaded with state debt, family wealth locked in local businesses and deposits, investors chasing yield while mistaking it for safety. This discussion is not about theory. It's about the moment when global storms hit Romania's fragile defenses and what families must do now to protect themselves, preserve their legacy, and build resilience for the next generation. Dr. Lemand, it's an honor to welcome you.
Thank you very much. Thank you for having me. It's an honor to me as well.
Please, can you just let us know before we start some question and some discussion between us? Can you just let us know exactly what you guys are doing and how you manage to bring the families from one stage to another stage, protect them, all of the holistic approach?
Absolutely. Thank you very much for the introduction. I'm flattered. So our group of companies is called Neo Vision Wealth Management. So we have presence in the UAE and we have presence in Switzerland. So the main activity of what we do is helping families institutionalize themselves and protect their wealth. The role of a wealth manager, an investment manager when advising a wealthy family is not to double or triple their wealth, is not to make them huge profits, it's to protect their wealth, help them protect it and help them in the succession event when it happens. So what we do basically is something called funds as a service or management company service, ManCo services. So we create funds specific to family offices to help them organize their assets and their wealth across local jurisdictions or multiple jurisdictions. Most of the families we cater for are multi-jurisdictional, so they are international. They're not confined to the UAE or the region. We can talk about that a bit later because the international aspect is extremely important. So by creating these funds, we help them institutionalize their investments. And then the second stage is advise them on how to protect their wealth and the way they invest.
Perfect. To be honest with you, the families here are as well trying to be more international, to maybe to have different tax residencies, to go from one stage to another because we have a lot of austerity. We're gonna talk about it. I'm gonna start before starting. Something you mentioned during the weekend when if hard work is the most important, a donkey can own the farm, which something is very funny and it's hit me. So this is something very nice. It's a quote of the weekend of Dr. Ryan.
Yep.
So let's start with the first question. What I want to ask you at your experience, the global debt is at record highs in all the world. Geopolitics are unstable. Liquidity is shrinking. From your vantage point, what is the single greatest systemic risk in the world right now?
So, as you mentioned, we go back to 2008, the crisis was basically a banking crisis. It was bank debt and corporate debt that completely blew up. It was the invention of structured credit, whereby we created these collateralized debt obligations, whereby banks were able to clear their balance sheets from the loans, package them, and sell them to other investors. This allowed banks to increase their loan-to-deposit ratios substantially high, and ultimately it was bound to blow up. Anything that goes to extremes ultimately will have to blow up. Any big and very fast rise will end up going down. This is the rule of financial markets. This is the law of gravity,
Absolutely.
and we've always seen it. Today, one of the biggest risks beyond government debt is non-bank debt or shadow bank debt. Today, there's a lot of private credits going around, being chased by investors. So it's becoming a very crowded trade. So it's hidden leverage because it's non-bank leverage, and it's really a substantial risk. The third risk, so government, private credit, and the third risk is the enormous overvaluation that we're seeing in US markets. Whether justified or not justified, no one disagrees that the US equities are in a bubble situation. And
Absolutely.
if this blows up, yes, it can have repercussions across the world.
So basically, when we say all these risks, Dr. Rayad, we as a wealth manager, and we do the same. How do you, basically your clients, what do they need? They need to be protected when they see it's overvalued there. So what do you do? Do you diversify the client's portfolio in something that is at least more relaxed when something or a risk will blow up somewhere?
So you see this white hair I have, it goes back to year 2000. Year 2000 with the tech bubble back then, with the internet bubble back then. I was a young trader and I believed in tech. I believed in the internet. Internet was coming to be. It was supposed to transform how we work, how we live, etc. And there was one company building routers. We obviously need routers for the internet. There was only one company in the US called Cisco. So
I know that.
we bet everything on it, just like everyone is betting on NVIDIA today.
Absolutely.
Cisco was a profitable company. It was making $2 billion a year in revenue. So it wasn't unprofitable. And ultimately, yes, everything crashed, came down crashing because it was very early. The Internet of Things came a decade or 15 years later. Okay. So today, the bet that is happening is quite early, in my opinion. The bet on AI. We're still quite far from adopting AI as we should. So this is to tell you that in our portfolio, in our model portfolio for our clients, we do not have US equities. And despite not having US equities, our year-to-date performance of our model portfolio is 25.4%. And
very good.
Being relatively low risk, to be honest. So we have Chinese equities, we have gold, we have certain commodities, we have some private investments. So you can perform, knowing that the S&P 500 is up, 12, 13% year to date. It wasn't that substantial. So there are alternatives where families can diversify and build their portfolios. Diversification has 4 parameters: the cash flow source, liquidity, the regime, and the jurisdiction. Every family should look at these 4 parameters when building a model portfolio for their wealth.
Okay, one question. When you say that your portfolios for the client doesn't include the US, which is one of the biggest or the biggest market or financial market, if you want to say, but how do you convince your clients that we should not include US market when every client is looking around right or left between like his friend or a marketing or whatever that buy Nvidia or look at these guys how much money they are doing, and we're missing, the psychology or behavior finance, they are missing opportunity. So how can you convince a family, or because we have the same issues, how do you convince them that this is the route, not this one?
It's by breaking it down, because today, if you look at US equities, it's really barbelled. On one side, you have the tech stocks that we all know, Nvidia, Alphabet, etc. And here, these are the ones that are driving the whole US equities. So today, we're seeing a price to sales 3.3. This is insane. So when we were in college, when we were in university, our professors used to tell us that when price to sales is above 1.5, that's overvalued. We are at 3.3 today on these stocks. So this is very much overvaluation by any standard. Any ratio, it is overvalued. And then at the other end, you have the small caps, the Russell 2000, small and medium size, which basically reflect the US economy, which are completely undervalued, and they are not moving at all because all of the money is going towards tech stocks. So when we tell our clients that we will build a portfolio for you, on one side, you as if they insist, on one side you have very overvalued stocks with price to sales of 3.3, and on the other hand, your portfolio will have to contain small and medium-sized companies, Russell 2000 companies, for diversification purposes, and there nothing is happening. Nothing. It's completely flat. Okay, and this is when they look at it, and where's the upside? Making dividends, and then we show them an alternative, or we show them other markets where there's undervalued, dividends can be 5 to 7%, and there is fundamental upside back there. It is a big battle with them to convince them this versus this,
Yes.
but you know what? They have seen the results. Another component is gold, for example. We've been betting on gold for 3 years now, 3 years. So when we started betting on gold 3 years ago, it was very difficult with clients as well, because ultimately it's a stone. It doesn't pay you dividends, so you're only betting at value. We have seen what's happening, what was going to happen today. We saw it coming, basically. And today, the big upside that our clients made on gold made it much easier for us to convince them to stay away from
Absolutely.
overvalued stocks.
They saw the record after your recommendation. Okay, let's talk about the fight between the bullish people and the bearish people now, which is a fight. It's been years they were saying a recession will happen, and these guys are betting against it and all of this. And us being in the middle, us and you guys as wealth managers, taking care of a portfolio of a family in a way that to be very diversified, not to be impacted a lot with the recession, and not to be the highest in terms of the return and risk-wise. So what do you think? Do you think if a shock or a recession will happen or something happen, I'm not gonna call it recession, will it be the same like the one we had it before, or it will be something different due to the huge amount of debt in the financial market since 2008, Corona, and up till now?
So the big elephant in the room is the US, the substantial
Absolutely.
amount of debt there, the budget deficit, which is not improving, by the way, despite tariffs, despite Doge. It's not yet improved. And the problem is that there's no plan. There doesn't seem to be a plan to reverse that debt. The second risk is that the US dollar is being abandoned. This is no secret, okay? If you look at the reserves of central banks around the world, they are replacing US Treasuries and US dollar with gold. And this today has become quite substantial. It's not negligible anymore. So if the US goes into recession, and I don't believe a recession will happen anytime soon, I'll say why in a second, I think the rest of the world is today relying less on the US dollar, that it will make this recession in the US less impactful. It will be more local to the US rather than feed into the rest of the world as we have seen in 2008.
Okay.
So it's thanks to countries moving away a bit from the US in this exposure. Now, why the US might not be very close to recession? Simply because of government spending. Government spending is astronomical in the UAE. Hiring of government employees, social services, education, etc., is really supporting the economy today. And the M2, the monetary base
Yes, the money
M2,
supply.
is at the absolute highs. So the US economy is flushed with cash. This allows banks to lend, because today they're not as tight as 2008 when they lent beyond reason. So they're able to lend, and as long as banks are able to lend, the economy continues to function. And I don't expect really a devastating recession anytime in the next few months.
So we can still ride the wave until the next impact or next shock. But I don't know. We believe that the European are still a bit more exposed in terms of if something happened in the US, more than the Asian or anyone in the other part of the world, because it's still linked Europe to the US based on
Yeah.
the, I don't know how we see it. But I want to go back into Romania a bit and ask your opinion about this, because you lived some crises and you know better than us. You advised exactly how to manage some crisis and for your clients. So when you an example of Romanian banks, like Romanian banks are heavily exposed to debt and to government bonds, especially government bonds, which is a huge. So if a global credit shock or what chain of reaction you would expect here objectively?
So again, I've seen it before. I'll talk about it in a second. So we've seen it in multiple countries. So if there's a global credit shock, the first thing that will happen is that bond prices will drop. When bond prices drop, the mark-to-market losses on bank balance sheets will show up. So banks will see losses on their balance sheet because they're holding these bonds that dropped in value. So when this drops on the bank balance sheets happen, they will have tighter lending standards. They would want to lend less because their balance sheet is now tighter. Funding costs will become higher because when a bond price drops, we know the interest rate is going higher,
Go up.
right? It's an inverse relationship. So tighter lending standards plus higher interest rates means there is slower growth in an economy, because economy relies on that cycle of lending of banks for projects, etc. So when there's slower growth, we will see weaker tax returns or tax revenue for the government. And this is where it becomes a sovereign issue, country issue, and a country goes into recession. It's absolutely typical, and we've seen it in multiple jurisdictions. Now, if you add to it that banks and central banks are holding government debt of their own country, this becomes what we call a double whammy. We've seen it in other countries as well, and particularly Lebanon. I went as an expert to Lebanon, to the Central Bank of Lebanon back in 2011 to discuss this specific matter. And we've seen what happened with Lebanon. For people who are not familiar with it.
They didn't listen.
Yes, no one listened, and there was a total collapse. Collapse of the currency, collapse of the banking system. So today there's no real functioning banking system in Lebanon, just because this inner circle of buying government debt within its own circle, rather than Eurobonds where you sell it outside of the country. So Lebanon defaulted on the Eurobond, and internally had the complete collapse of the banking system.
Basically, if the Romanian family is holding that, these call them state bond titul de stat. So do you think it's considering, for any family considering this state bond is risk free, because it's a psychology behavior thing, considering themselves and their country as a risk free. No way the country will miss one payment. So the lessons that you live them from Lebanon or other countries, because we have
Greece.
a lot of countries that we can. Greece as well. So how this behavior belief, how much is dangerous for families?
This is very dangerous, especially if, so families, they have to trust two sources of wealth and income. One is through the businesses they run, and these businesses are what allowed them to become wealthy. And then this wealth, it's invested. So these two sources are where these families derive returns and revenue from. Now, if they are in a country where their companies are, and this is where they're deriving their business revenue from, and then they take that money and they reinvest it in the same place in debt of that same country, this is again a double whammy. This is very, very dangerous. So generally, you do not reinvest the money you make from your business in the same geographic location or jurisdiction than the one you are. Let me give you a small example. If you look at the big, very large sovereign wealth funds around the world, the Norwegian one or the second largest, which is here in Abu Dhabi, they do not invest internally. So Abu Dhabi Investment Authority, which is the second largest sovereign wealth fund in the world, here in the UAE in Abu Dhabi, all of their investments are outside of the UAE because they derive their cash from selling oil, government revenue, etc. But they do not reinvest it here because it's doubling up their risks. And that is why when I started and I said there are four things that families should consider when they invest: cash flow, liquidity, regime, and jurisdiction.
Absolutely. So basically the only thing that you can say for families exposed from their business and reinvesting their own money and their own money that they did from their business into the debt of their own country, the only thing that you can tell them now, and what is their only hidden risk that they will never see it. As a family coming to you as a wealth manager, they come with a lot of behavior and psychology issues, and so what can you tell them that there is a risk that they don't assume?
Risk-free does not exist. Risk-free does not exist.
The one we learned in the finance doesn't exist. Not even the US risk-free.
United States, when we were in university, we used the formula, Black-Scholes, etc. We used to have the risk-free rate, right? That risk-free rate used to be derived from US Treasury bonds.
Absolutely.
But this doesn't exist anymore because the United States is no longer a AAA country. This is over, okay? There's nothing today called risk-free. When you buy the bonds of your country, the banks are buying the same bonds and the central bank is buying the same bonds. The slightest credit shock could affect this whole ecosystem. Again, we've seen it in Greece, we've seen it in Lebanon, we've seen it in the UK in 2022. So this can happen anywhere. In the UK, one of the cabinet ministers has said the United Kingdom, Britain, can ask for IMF support in 3 years. In 3 years, this
Right.
is the UK, okay? So there's nothing called risk-free, and investors should be very, very wary and careful and rely on diversification.
So basically, if UK is asking for IMF and France is asking for IMF, I don't know who is not asking for IMF at the moment. So it's very difficult. Dr. Ryan, I want to ask you, you build portfolios for resilient portfolios for government institutional families. So for Romanian families that they are first here in Romania, most of the families are first generation. After 90s, they build their wealth. They arrive to 60, 65, 70. They have huge wealth. They build it. But how should they start build resilience step by step? Because a resilient and the structure and the clarity is needed.
So let me give you an example of the family offices here in the UAE. Oil was discovered back in the 70s here in the UAE, and there was large amounts of wealth that went into the families because they did businesses linked to oil, and then it expanded. Now, this wealth was mostly reinvested in the country. So they used to buy real estate, buildings, rent them out, generate 10 to 12% in rental revenue, quite high. They used to invest in locally listed stocks, dividends 5 to 7%, stocks are only going up. That was basically the major component of these family office portfolios. And then we had the jump. Many of these families had a jump of a generation from the grandfather to the grandson. The grandson enjoyed the new wealth, studied at Harvard, Cambridge, Oxford, westernized, etc., and came back to the country wanting to diversify. And this is where we started to see 5 to 10 years ago, these families investing into tech, Silicon Valley, private equity, commodities. Really, they started diversifying their portfolios rather than only focusing on real estate and local stocks. So it's the first step is to institutionalize the family office. So usually family offices are not institutionalized. It's in the name of persons, there's no succession, there's no governance, there's no board, there's no independent advisory. Institutionalizing the family is the first step before investing one dime. This is the most important part. Having the adequate governance, having a separation between family and business, having contracts in place, this is absolutely essential before starting to invest. If you start investing and then you do all of these things later, well, it doesn't work.
Yes. Basically, based on your experience when you start working with family offices or family businesses, let's call them, because here I need to separate between family business and family office. In Romania, family businesses exist. Family offices doesn't exist.
Yes.
Maybe we have one or two family offices. So we're trying as well us to build a multi-family office. From your experience, when you start working with I don't know, maybe second generation, third, fourth generation in the UAE or worldwide, it was hard for you to convince families to start or to make it more to structure their family offices or to be part of a multi-family office. It was a difficult job to do this because and what we see here, and I need your advice as well. Here, families, they like real estate. They touch it. You know, the Asian and the Arabs think that they need to touch their real estate. Their gold, of course. But other than this, what else can we do? So how did you manage to go through this experience? Because I'm sure it was not easy experience.
It's actually very hard because, as you rightly mentioned, when you want to convince the family that family business is one thing and the family office is another thing that has to be handled differently, letting go of this is very hard sometimes.
Of course.
Because control is very important for a family. It's really hard-earned money and assets that they do over the years. Letting it go becomes quite complicated. Now, when you show them international best practices, successful business models, successful family offices in other jurisdictions that are hundreds of years old, this is when they start seeing a bit better that, oh yes, it makes sense. Because if I do this, I avoid this problem. If I adopt a governance structure that is robust, I avoid fighting with my brothers later on. If I separate my family business from my family office, if I'm having a bad day in my family business, This will not impact my family office. So it's really showing them best practices and successful lessons learned around the world, failures and successes. You get there. Now, it doesn't happen from one day to another. There's
Of course, it
always a
takes time.
test. Yes. So the approach is very slow. Let me show you that I can succeed in changing things for you, lowering risk for you. When they actually see it and touch it, this is where it becomes more convincing to them, and they made that flip. Another ally in this transformation is the younger generation. The younger generation
Yes.
that got exposed to developed jurisdictions, came back with lessons learned as well. They help convince the patriarch or the older generation that this is the way to go.
So basically, if you want to, what separates, from your point of view, the families that they can stay for multiple generations and the families that they can disappear in 1 or 2 generations? Do you think the structure they build, or the way they are open to receive the information, or when they feel it from their pocket, when they start losing money or losing from first generation? What separate these two from your point of view?
So one of the important things is building a buffer. So one of the first things I tell families before you do anything, before you start expanding your business, because let's say you have a small business in small part of the city that is very successful. The first reaction of the family business, let's expand. Let's open a business in the other city. Let's do this. Let's go to another country. So what I tell them, before you do anything, build your buffer. Do you have a 24 months buffer or not? So once
Absolutely.
they have that 24 months buffer, yes, this is when you start expanding selectively. So most of the families that really, as you said, collapse after just a few years, one is overspending without looking at the buffer, and two, expanding without a clear plan. It's actually very simple. This is what makes most family offices, family business I've seen collapse.
Dr. Ryan, I want to, the last, before we close, and I want you to give a message tonight for Romanian families, Romanian entrepreneurs. What kind of message you can give them, especially based on your experience, your exposure, the way you built families, institutional, and in the UAE and all over the world, and hopefully you come and collaborate with us as well in Romania. We're always welcome here with us.
Thank
So
you.
what message you give to Romanian families and entrepreneur in this moment, in this very tough moment in Romania, with austerity, with a lot of things happening, and in a world of all of risks?
We are in a world today where reverse globalization is happening. Reverse globalization is happening, okay? Tariffs, barriers, geopolitical tensions, etc. The first natural reaction of anyone is, you know what? I will just stick to my local jurisdiction to protect myself. This is the worst thing that can be done. Internationalization is very, very important. Jurisdictional selection is very important. Staying local in a reverse globalization trend and geopolitical tensions is like placing all of your eggs in one basket. If that one basket breaks, all of the eggs break. So it's counterintuitive. Internationalization and diversification across multiple jurisdictions, it is what will protect these families. And I think what will protect Romania as well. Because if these families are resilient, if these families are invested abroad as well, and their portfolios are protected, they can protect Romania as well.
Absolutely.
Because their collapse will contribute to the collapse of Romania.
Dr. Lemand, tonight you reminded us that risks may be global, but their impact is always personal. From debt crisis to contagion, from regulation to fragility, the lesson is very clear. Wealth without structure is just exposure in disguise. For Romania, this message is urgent. Families cannot rely on the state, on banks, or on short-term yields to protect them. They must build the structures, family offices, diversification, governance that transform fragility into resilience. Around the world, families are preparing for shocks that come without warnings. Romania must do the same, or risk watching first generation wealth dissolve at first global storm. On behalf of Heritage Capital Wealth, We thank you, Dr. Lemand, for showing us that the path from fragility to resilience is not a theory, it's a choice. And to our audience, the time to prepare is before the crisis, not after the crisis. Global risks are here. The question is whether Romania's family will face them fragile or ready. Thank you, Dr. Lemand, and see you on the next episode of Heritage Capital Wealth Talks.
Thank you very much for having me. It has been a pleasure.